Welcome to Bloomberg Markets. I'm Sonali Basak. Big-time earnings roll in as we count down to the U.S. election and the big Fed decision. We talked to 3 CEOs this hour about their earnings. But first, let's see where the markets stand as we hit noon, Wall Street time. Check on the markets here. The S&P 500 has been going south a little bit today. You have a 1.5% decline in the index, and that's the worst day you've seen since early September. Same too for the NASDAQ 100. You're seeing it down now about 2.3%. I've got to say, for the S&P 500, we will be ending October as the worst month since April. So tough month that we have seen. We're also seeing the 2-year camping out around 416 and the 10-year at 429. It's a stunning place to be standing at ahead of a jobs day tomorrow. And of course, after PCE today, a lot of noise before that Fed meeting next week. Some midday movers here on the equity side. We're going to bring in Bloomberg's Abigail Doolittle for that.
Well, naturally, Sonali, we're going to have to check out this tumble in big tech, really taking the lead here. Microsoft down 5.5%. The quarter they reported was okay, but the growth for their cloud product, the outlook disappointing, down sequentially to 31 to 32% from 34% and a quarter below before 35%. So investors not liking that. Meta Platforms down 4.2%. They actually beat adjusted earnings in a big way, but talking about AI demand maybe being a little bit shaky, plus costs, spending expected to rise. Amazon after the quarter, after the bell, I should say today, Microsoft and Meta not really setting a nice platform for them. And then NVIDIA going along for the ride. They don't report until toward the end of November. So big tech really taking a pause, as you had mentioned, the worst day since the beginning of September. We'll again find out more after the bell with both Amazon and Apple. Taking a look at one stock that is certainly working to the upside in the opposite direction, this would be Carvana. Shares absolutely soaring, up 22%. The used car sales for this company have just really soared. They've also provided a bullish outlook. This is the best day since May, and on the year, this stock up the better part of 400%. So they, of course, had liquidity and going concerns not so long ago, and investors bought that up and are doing quite well with it. And then finally, Roku, another one to the downside, tumbling down 21.4%. This after the stock, the worst day since February of 2024. They are going to stop reporting their quarterly numbers of households using their products, similar to Netflix. Investors, though, Sonali, clearly not liking that decision at all.
Absolutely, Abby. Fascinating day, of course. You're seeing some mega moves here in markets on the heels of earnings. Amazing to see in either direction. You have seen significant double-digit gains or losses. Also want to point out another story here. Comcast said it's considering spinning off its cable networks into a new company as it grapples with continuing industry-wide declines in subscribers. And you are seeing a jump in Comcast shares today, particularly off the news. Back at Bloomberg's Screen Time event on October 10th, Comcast CEO Brian Roberts was asked about the spinoff reports. He commented on the state of the cable business.
There could be more decline. It could level off. YouTube TV, Hulu Live.
Is it going to hurt your soul a little bit if YouTube TV surpasses you as the biggest cable operator?
Not if they're using Xfinity broadband and watching NBC and watching everything. We will have transitioned our company pretty carefully. We're going to, be pretty happy with the Comcast NBC Universal we got.
And want to also just pull up a little more on what Comcast is doing here, because as I said, it is a fascinating move because you are seeing just spinoffs take over the M&A landscape here, and companies reacting really well to the idea of it. Investors really like the idea. It's up about 3%, and this is a stock also that has otherwise been down on the year by just a little over 1%. So it's pretty fascinating to see the moves, particularly in the media industry as well. Remember, Comcast is not the only one that is looking to change up its business. We are still looking at a lot of media companies reporting in the coming days as well. Now, we're going to turn soon to the U.S. economy. Remember, we had PCE out today, aligned with expectations. We're going to talk about that a lot more after the break, because the changing rate environment has been a big part of what has been underpinning this market. Rates have stayed higher for longer. The market not reacting very well to earnings. And, of course, We will talk more about that next. This is Bloomberg. This is Bloomberg Markets. I'm Shonali Basak. Let's get you a check on those markets because, as we've been saying, it has been a pretty brutal day out there. You're looking at the S&P 500 now down even more on the day, around 1.5%. That NASDAQ 100, remember, people pretty disappointed with those big tech earnings out overnight after we've seen some of those Mag 7 stocks just fly to fresh heights. But we are seeing people take some chips off the table. Also going to, of course, talk about different sectors, though, because not every stock is in the red today. We're actually going to go to one in particular. We're going to talk about Carvana because it had reported results after hours yesterday. Results had showed resilient demand for used cars. Carvana earnings beat analyst estimates on adjusted EBITDA, revenue, and earnings per share. And we're going to be joined now by Carvana CEO Ernie Garcia. And, you know, it's interesting. You are starting to see people really come back. They are trying to buy used cars in particular. What does the pipeline really look like and consumer appetite look like going into the end of the year?
Yeah, well, thanks for having us. We're happy to be here. I think I think Carvana's been doing a lot of work over the last couple of years to try to get ourselves to a great spot. I think the last 2 years, 7 quarters or so, we've had incredible results. The team's been doing a great job. We're extremely proud of those results. I think a lot of what you're seeing right now has more to do with us making sure that we're delivering to customers simple experiences they love that are a great deal for them and that enable us to do a great job financially as well. And so I think this is a lot more about Carvana in particular than the industry in general, but the industry in general is chugging along and looks pretty stable as well, and that's a great industry for us.
Hey, Ernie, I'm here too. Matt Miller.
Hey, how you doing?
Happen to be on set with Shonali. Hey, listen, a couple of years ago, you bought a wholesaler, Odessa, and I think at the time it was a couple of $1 billion for the acquisition. People were worried that the associated borrowing was going to be a drag. It turns out to have been, I think, a brilliant move because it's helped you really grow your network to prep cars for sale. How much of a piece of that of your success is that Odessa acquisition?
Yeah, well, first of all, thanks for the characterization. It's brilliant. We'll take that all day long. I think undoubtedly, it's a big part of our machine, and we're extremely excited about it. I think, building something different for customers where you have a chance for a real win-win, where it's different for them and it's different for us economically as well, is hard. It takes a ton of work. It takes a ton of ambition. It takes a long time, and oftentimes the road there is a little bit bumpy, and I think that was certainly the case for us. But it was something we had conviction in at the time. I think it's something that's showing up now to really be playing out well. It's great for the Odessa business and for their customers. It's great for our business. And so we're excited. We still have a ton of work left to do to get the full benefits out of that acquisition. But I think we're well on our way, and it's an exciting time.
How do you differentiate yourself in this business? Not a lot of people buy multiple cars per year, so they don't have the experience you would have with shopping for a lower price ticket item. How do you differentiate yourself from other used car businesses when it's often a decision people only make once every 4 or 5 years or 10?
Yeah, sure. Well, I think the most important thing is make the experience, very simple and meaningfully different. I think, we've built our machine where we're totally vertically integrated. So all the decisions around financing, around the price of the car, around trade-in value, it's all made by us. All the systems are our own. And so customers can buy a car in minutes instead of hours. The experience is very simple. They have a huge selection. They go through the whole process with complete transparency. And so they walk out of it confident. And I think that leaves, an indelible mark in their mind that they remember for longer. I think there's no question that there are advantages to businesses where transactions happen with higher frequency, but there's also an advantage to being able to create a truly differentiated experience that customers remember. And so our job is to give them great experiences, and they tell their friends, and then that leads to the kind of results we've seen over the last couple of years.
Ernie, the other question I have, too, is around not your stock price, which is, up more than 380% this year, but about the other side of the equation here and the debt picture for Carvana. You're looking at, according to Bloomberg's DDIS page, $5.3 billion worth of total debt outstanding, really termed out to 2031. How do you expect to pay some of that down next year? Now that operations seem to be improving so much, where does that go?
Yeah, well, I think we're going to keep turning the wheel. I think the most important thing we can do is keep performing well as a business, which is driven by all the simple fundamental things. Give customers a great transaction, keep making the business more efficient, so it makes it better for them and more efficient for us economically. We were lucky enough to have very significant net income this quarter. It was $148 million. So we're generating a lot of cash. That allows us to pay down the debt over time. We do plan to delever. But we're in a great spot, and I think that's not a central part of our consideration right now. What we're really focused on is just continuing to turn the wheel and get a little better every day, and I think that's been paying big dividends over the last couple of years.
Ernie, we thank you so very much for joining us today on the heels of earnings. Of course, that is Carvana CEO Ernie Garcia. We're going to switch gears here. We're going to turn now to the U.S. economy because the Fed's favorite gauge of inflation was out today in line with expectations. And it's a big day tomorrow because we have, of course, the jobs report. We're going to go live now to the White House, where we are joined by Jared Bernstein, the chair of the Council of Economic Advisors. And first, perhaps, Jared, speak to where you see inflation right now, because, of course, it did come in right in line with expectations, but there were some critical components that matter the most to Americans as well, like food, where you saw bigger jumps than others.
Well, first of all, sticking with the top line, PCE inflation 2.1%. That's just about back to the Fed's target, and it's consistent with a trend in easing inflation. As you've mentioned, some different components are going in different directions. We're always going to get that. But when it comes to grocery prices, we know that grocery prices were growing at double-digit inflation a year and a half ago. They've come down to, I believe in this report, about 1% year over year. Now, the important thing there is to recognize how this strong job market, strong GDP growth, and easing inflation has raised real paychecks, raised real disposable income. That was in today's report as well. And of course, consumer spending, strong consumer spending, reflects those gains. So when you actually look at how much families have to work to buy a bag of groceries, it's about the same now as it was before the pandemic. We have a lot more work to do to bring costs down, but it's important to look at both sides of the ledger, the price movements as well as the wage and income movements.
I'm very curious. I know you can't comment directly on the Federal Reserve as well, but after that first 50 basis point rate cut, do you think that there's really the ability to declare more victory and further see room for interest rate cuts given where we are right now? Because you also see the biggest monthly gain since April when you look at core numbers here.
Well, first of all, let me speak from our perspective at the White House, which is no declarations of victory, no victory laps. Yes, we're really happy to see the positive data flow we've seen, and particularly to achieve all this disinflation in the context of solid, strong growth and a tight labor market. As you well know, many news outlets and many economists said we weren't going to be able to get here without a recession, and certainly that's not been the case. When it comes to the Federal Reserve, I think a very important observation is the one you made at the beginning of the segment. The numbers came in at expectations. That's very important for them. It means they understand where things are going, and that would strike me as consistent with their plans. But that's all that I'll say about Fed policy. So again, as long as real pay is up and the economy underneath it remains solid, that's a positive trend for consumers and households. Doesn't mean anything about our cost-cutting agenda. We have to continue to work to lower the cost of housing, of childcare, of prescription drugs, of healthcare coverage. We're actively doing so, and we'll continue to do so, and we'll continue to fight those who would repeal those advances, leading to higher costs.
You know, you had mentioned jobs a few times, and I'm glad you did, because of course there's another payrolls report out tomorrow. How concerned are you about the potential downside surprise to payrolls given any consequences of Hurricanes Helene and Milton?
Well, we've been very clear here at the White House. I spoke from the podium on this yesterday, that this is a report that has the potential, we don't know yet, we haven't seen it, this has the potential to be, significantly distorted by some things that happened in October. One thing we know that's going to be in the report on the payroll side would be about 41,000 fewer jobs due to ongoing strikes in the reference week. The Bureau of Labor Statistics has that number. They publish it. It's well understood by analysts. So that's a negative. The uncertain part comes from the hurricanes. Now, in the past, hurricanes have had not that much impact on payrolls in some cases, and in other cases, a great deal of impact on payrolls. So we'll just have to wait and see. But I think the important thing to remember is this is a month where you want to recognize that the signal is very possibly distorted. The noise is very possibly elevated. So we're going to want to look at longer term trends. And at least, thus far through the September number, we see a solid labor market still very much in play.
I also want to talk about the data we have already gotten. You've seen job openings declining in the most recent report out in JOLTS. But with the labor market seemingly cooling as well, do you worry about lower wage growth at a time when inflation is still above the Fed's target?
Well, I think the key thing there is to think about real wage growth, okay? Are wages beating prices? Now, I think we got the employment cost index this morning, and if I recall numbers there, we saw wage growth in the ECI, nominal wage growth year over year, somewhere around 3.5%, I believe a little bit north of that. We know inflation came in at around 2%. That's real wage gains. And we've seen the same thing in the today's consumer price report. Of course, that also had consumer spending and real after-tax income. Disposable income, after-tax income, is up in real terms about $4,000 since President Biden took office, and numerous months in a row in terms of real disposable income, that is, beating prices. So buying power is definitely up, and the key thing there is to maintain the strength of the job market while inflation continues to ease, and with the caveat that tomorrow's data are going to be potentially distorted. The longer-term trend in the labor market has certainly been quite positive.
Of course, these are very critical data points moving into the election, both inflation today and jobs tomorrow. As we think about the election and look to turn the page, what would you give in terms of a grade if this were a report card on this administration for where they have taken the economy and are leaving it in the hands of the next generation now?
I would recuse myself from that very good question, because I'd be grading myself and our team, and I don't want to do that. I will say the following. We have a GDP growth rate over this president on an annualized basis north of 3%. I think that's something like the 10th highest rated of any administration, certainly the highest in the 21st century. We have an unemployment rate that's averaged at a 50-year low. 16 million jobs, manufacturing jobs coming back in a really strong fashion. And now we have deep domestic investments in production here on American soil of clean energy goods, of semiconductors, and of course batteries, EVs. All of that is under this administration. Now, when you talk about a soft landing, when you talk about achieving these goals without seeing the kind of recessionary predictions that were made, I think that would yield to a high grade, but I'm going to leave that to others.
Jared, we thank you so much for your time. That is Jared Bernstein. He is the chair of the Council of Economic Advisors. And over in the UK Chancellor of the Exchequer, Rachel Reeves, just presented her budget. We're going to go there now with Bloomberg's Lizzie Burden, who is standing by with the Chancellor.
Well, indeed, thank you, Shonali. And we did have that first Labour budget in over 14 years yesterday. The market reaction has been something to behold. Chancellor Rachel Reeves, thank you so much for joining me. I feel like I'm kind of here for a reason, because we've seen such a ferocious gilt sell-off. It's spreading now to stocks and sterling. Are you worried that we're heading for a Liz Truss situation?
The number one commitment of this government is economic and fiscal stability, which is why we put in place yesterday in the budget robust fiscal rules that we will meet 2 years early. There's a significant fiscal consolidation during the course of this Parliament that takes debt as a share of our economy from 4.5%, which is what we inherited, to 2.1% of GDP. And we've set out a framework for the second phase of the spending review based on the envelope that we set out yesterday. That will require difficult decisions, but they're ones that this government are prepared to make because we know the importance of economic and fiscal stability.
But Chancellor, your margin for error for meeting your main fiscal rules near historic lows. If there's even a minor hit to growth, you'd have to hike taxes more to hit your fiscal rule. That's not very stable for the bond vigilantes, is it?
We have more headroom than the previous government left us, and that is important to guard against those sorts of shocks. But we, in the budget yesterday, were open and honest about the scale of the challenge left to us by the previous government, but we have now put our public finances on a stable and a solid trajectory, including through difficult decisions on increasing taxes. We did increase taxes yesterday by £40 billion. That was necessary, alongside with the changes we've made on spending and welfare, to put our public finances on a firm trajectory, and that's what we did in the budget yesterday.
But how can investors believe that this is a one-off hit when you repeatedly said before the election you weren't going to raise taxes beyond your manifesto commitments? Now you've raised them £20 billion more than the fiscal hole the Tories left behind.
Well, we were left with a terrible situation by the previous government, a big black hole in the public finances, a number of commitments around infected blood and the post office scandal that weren't properly funded. We've now put all of that out in the open, and we've raised taxes in a way that now put our public finances on a stable trajectory. Indeed, the Office of Budget Responsibility confirmed that we meet both our stability and our investment rule 2 years early. That should give confidence, alongside what the International Monetary Fund said yesterday, that these were the right decisions for our public finances and indeed for growth. We're making the decisions to get our public finances on a firm trajectory and also to boost the growth potential of our economy.
But the IMF endorsement is almost out of date now, given the market reaction, and a lot of people are going to be asking what the point of all these tax rises was when the OBR sees the economy growing more slowly under this Parliament, under your plans, than if Rishi Sunak had stayed Prime Minister.
But the OBR say that their forecast in March would have been materially different if they knew then what they know now about the previous government spending plans. So those comparisons aren't fair ones to make. The OBR say that growth will be around the same in this Parliament as what they said previously. But of course, those projections were based on the spending projections, which weren't real. The growth forecasts, though, aren't the summit of my ambition, which is why we are doing planning reform, pensions reform, skills reform to get our country growing again, and we're determined to do that. But the OBR also say that over the longer term, our plans will boost GDP by 1.4%. That is significant. Well, 1.4% when our economy has barely grown the last 5 years. It is a significant boost to growth. But it shows that this government,
2.5% target.
It shows that this government, and this is 1.4% in addition to the growth we're already experiencing, just to be clear about that, and that would be a big uplift on the growth that we've experienced the last few years. But we're doing more to boost growth. We're getting Britain building again with those planning reforms. We're unlocking long-term patient capital to help small businesses and start-up and scale-up businesses to grow. All of that could have a big impact on growth, as could the £63.5 billion investment that this government unlocked at our International Investment Summit just 2 weeks ago.
And yet, Chancellor, for all your revenue raising, there are still going to be real terms cuts for some government departments. If that's not the definition of austerity, what is?
That's not correct. The numbers we put out yesterday that shows real terms increases to government spending of 1.5% during the course of this Parliament, 1.7% if you take into account capital spending as well.
And many
Austerity,
had expected 2%.
Well, that would be even higher than the growth rates being forecast. Austerity is when you're cutting public spending. We're not cutting public spending, but it will require difficult decisions. And we set out the envelope for spending in the Parliament ahead at the budget said yesterday, we are determined to live within our means. We are conducting a zero-based review to drive efficiency and productivity across government, because better public services are not just about money, it's about running those public services better, and that is what we're going to do.
Well, indeed, think tanks like the Resolution Foundation are saying inevitably employers are going to pass on this national insurance rise to workers, that this is going to be the worst term for living standards under any Labour government. Yes, you're not technically raising taxes on working people, but if you're honest, it's going to feel like it, won't it?
Well, the last Parliament saw living standards stagnate. It was the worst Parliament for living standards ever recorded. The Office of Budget Responsibility forecast yesterday that real household disposable income will increase on average by 0.5% in real terms per year. So that is a world away from the stagnating living standards that we saw in the last Parliament. But do we want to do more? Absolutely. That's why we're introducing planning reform, the pensions reform, the skills reform, to get Britain building, to get our economy growing again, bringing in private sector investment, for example, through the National Wealth Fund and through the International Investment Summit that unlocked £63.5 billion of private investment in the UK, showing the confidence that business and investors have in this government and our strategy.
Chancellor, you keep emphasising the long term here. Do you worry that you're not going to get 2 terms in government to realise your ambitions, to get to the summit of your ambitions, because it's going to take a decade of national renewal for people to feel better off? I'm thinking about George Bush Sr. saying, read my lips, no new taxes, and he was out after 1 term.
Well, we made it was a significant budget yesterday, but that budget wipes the slate clean so that we never have to do a budget like this again. We are cleaning up the mess left by the previous government, but we are meeting our fiscal rules 2 years early. We've set the spending path for public services for the course of this Parliament. We will do a zero-based review to make sure we're getting value for money for that spending. We have had to make tax increases, but that is to get our public finances on a sustainable footing. Economic and fiscal stability are the #1 priorities of this government, and we will meet them.
So can I take that confirmation, no tax rises for the rest of this Parliament?
Well, no Chancellor is going to be able to tie their hands in that way, but there was a significant budget yesterday because we had to wipe the slate clean after the economic mismanagement, the chaos and the instability from the previous government. No government should have found themselves in the position that we did, having to clear up that mess. We've now done that, and we can move on.
Chancellor Rachel Reeves, thank you so much.
Thank you.
Back to you, Shonali.
Thank you, Bloomberg's Lizzie Burden and UK Chancellor Rachel Reeves. We're going to get a check on the markets here as well, because we've been talking about these moves are pretty drastic. I mean, they're the worst you've seen in weeks since the beginning of September. You're seeing the S&P 500 down 1.5%. You're watching the NASDAQ 100 also down another 1.2% after those big tech earnings overnight. And you're expecting, of course, more tonight with Amazon and Apple. You're watching the 2-year yield just standing around 4.16, a move about 2 basis points. You're seeing some movement in the 10-year as well. And that's all ahead of a hefty jobs print tomorrow morning. 10-year still below 430, but at 428. So levels that really make you question what that next rate cut less than a week from now will look like. We are going to look at some midday movers on the equity side. I'm going to take a look at those here myself. Let's pull up a board here and see what's moving under the market. We're taking a look here at cosmetic collapsing here. We're looking at Estee Lauder. Remember, it's down more than 20%. It's not as bad as you saw a little bit earlier in the day. We're seeing, of course, a change in management there, but we're not seeing the moves that you would have otherwise. It really has been a tough day for this stock. You've been seeing it down more than you've seen it really fall ever. We're going to also take a move here and go to Bloomberg's Money Undercover, which is our weekly segment where we cover unique challenges and opportunities facing the world of alternative investments. Shift away here from the crazy market moves and bring in Bloomberg surveillance anchor Lisa Abramowitz.
Shonali, thank you so much. Today, I have to say, I am very excited for this guest. She is Sarah Samuels, a partner at NEPC. It's a consulting firm that advises endowments, foundations, retirement retirement plans, insurers, and more, which collectively manage about $1.7 trillion. Basically, she's the one who takes the money and matches it with the investments and really understands where the opportunities are at. Sarah, thank you so much for being with us. I want to start with the narrative that's been dominating the discussion in public markets, which is the election. And it's caused a lot of people to remain on the sidelines and not really be as active. Are you seeing the same kind of hesitancy over in private markets as well?
We certainly have seen some disruption in private market commitments. And so when we think about the three major things that I would like to impart today to any listeners, one is that there is a lack of liquidity, and that's a challenge in private markets. Two is that public markets alone are not going to get you to where you need to be as an institution. And three is that a chief investment officer mindset is really required to be successful in today's sort of gnarly markets. But to your point about the election, markets hate uncertainty, and this is not uncommon.
The institutions that you talk to, are they just assuming that going forward, they're not going to get very big returns, even from public stock markets? Is that basically the assumption that we've brought forward a lot of the returns and that we're going to be looking at kind of single digit, 5, 6, 7% types of returns for a long period of time?
Yes. So this is where that chief investment officer mindset comes into play. We don't want to think in silos. We want to think across the entire opportunity set, the whole liquidity spectrum. And so in public markets, whether it's credit or equities, over the next 10 years, we're expecting returns that are in the mid-single digits. That's not going to get institutions where they need to be over the long term. Most institutions have a return target of anywhere between 7 and 8% to support their missions. But we still believe that private markets will have a premium to public markets for a variety of reasons. And we do expect double-digit returns, provided that you can partner with the strongest GPs. The spread of distribution of returns in private markets is incredibly wide, upwards of 50% from the best manager to the worst. You can't just show up in the beta of private markets. And we've been able to deliver returns between 4% and 7% higher than public markets in our private program.
How much are you seeing the dispersion in performance based on size? That smaller managers are either getting an edge or that bigger managers are getting an edge one way or another?
So there's a lot more to it than just size. There is sector, there's a degree of leverage that's being put on, and there is just overall health of an organization. So we're going to look at things like, is it possible that they're able to add returns without needing to rely on leverage, for example, when we look at buyouts. We're happy to pay full freight fees for earnings growth and multiple expansion, but leverage isn't going to work the way that it used to, especially with the cost of financing about twice as expensive as it was a few years ago.
I was speaking to someone in the market recently who was talking about the lack of IPOs, the lack of exits from some of these buyout and private equity funds. And this individual said to me, you know, anyone who says that the market is closed is crazy. What you're really looking at is a lot of LPs who don't like the valuations and they don't want to sell at what they would get, but they can sell and they can IPO. The market is open. Is that your experience too? Are we going to need to see a real reset before that market really becomes the main attractor of cash the way it used to be?
I do think we need a reset. We've seen a partial reset in valuations across buyouts, across credit, and across venture capital. But we haven't seen enough. And so what we're seeing is that some deals are getting done. In venture capital, we've seen some exit activity. Mostly that's publicly traded stocks that are being held in venture private funds that have been sold off first, upwards of a third of institutions' portfolios last year. Now we need to get to the real work of selling actual companies. In venture, many times the last round of financing is the valuation methodology. And these companies won't reset their pricing until they price a new round. And so what we're seeing is valuations being held at the 2021 and 22 peaks. So for the dollars in the ground in venture, we expect some pain to come. Buyers and sellers need to move a little to meet in the middle. In buyouts, the same type of thing is happening, not in the valuation methodology side, but we are seeing that buyers and sellers are struggling to meet. Highest quality assets are being sold. And when a buyer is showing up in an auction, it's a much thinner market. Used to see a dozen buyers, now it might be 2 or 3.
Is this the tech startups that you're talking about that all plan to IPO and now can't?
It's not necessarily. IPO isn't the lion's share of exit opportunities in most cases. It's the most visible, but M&A is historically, or sponsor to sponsor.
So how much is the M&A an issue of valuations and just someone not liking the price? And how much is it actually a question around lack of ability, regulation, some potential hang-up on that front?
Sometimes there are antitrust issues. Sometimes there are actual issues with getting it done. But I believe for the most part it's valuations and buyers and sellers not being able to. We're at a bit of an impasse.
How much do you see there as a note of caution that everyone is sort of seeking haven in private credit? And money just keeps flooding in. People have talked about the golden era of credit. They keep talking about that. It's all funneling toward AI-related investments and anything that has that in the name. Does that concern you at any level?
AI valuations are lofty. They're far and above, they're multiples above valuations of other sectors. So anything that's playing in the AI space, it does need capitalization, it does need investment, and it's a theme that we do believe in. But this is where it's really important to partner with the best GPs out there, because separating the wheat from the chaff, the signal from the noise is everything, and not all AI companies are going to be winners.
How optimistic are the investors who you speak to right now? Do they feel like they want to take a lot of risk and they want to go into some of these areas? Or are they feeling kind of nervous?
So it's interesting because public markets portfolios continue to be strong, even with today's sell-off. And that's keeping investment programs overall pretty healthy. Liquidity is a challenge, as I mentioned. And so we're seeing some institutions that we work with for the first time in their history ever having zero distributions from their private markets program in the last quarter. And if that continues, that could cause some problems. But for right now, institutions are not in dire straits. When we don't have distributions coming back, the private markets market value stays elevated, which means that we don't need to commit as much to get to our target private markets allocation because it's not coming out of the portfolio. So we're seeing that commitments from limited partners and institutions to private markets are down about 20% year over year, but they're still committing.
Okay, before you go, is private debt is part of the allure that you get a stream of income, especially at a time when in the buyout world, in the venture capital world, you're not getting those distributions because you're not getting the exits. So that basically mar the idea this could be an ongoing stream of income, aside from just park your money for a certain amount of time and get it back and then some later.
So it's interesting. I think liquidity and distributions are in the eye of the beholder. So if you're a private wealth investor, you may not want private debt to be kicking back that income because it will have impacts on how you're taxed. If you're a different type of investor, it's not really nice to have that income. The other thing from a portfolio management, from a CIO perspective, is that private debt funds have a totally different cadence. They're shorter duration, and so it's a really nice way to fill out an overall portfolio paired with venture, which is 15 years, private debt maybe 5 or 6. But you really need to be careful that you're partnering with GPs who know what they're doing, they have workout capabilities, and they've done this before.
Sarah Samuels, thank you so much. Absolutely instructive and illuminating. Thank you again. I'm going to hand it back to you, Sonali.
Lisa, we thank you so very much. We're also going to bring you guys some breaking news now, of course, as well, because you are seeing OpenAI bringing search features to ChatGPT, challenging Google. The option is going to be called ChatGPT Search. And on reaction, you have Alphabet shares actually down near session lows on the day. This was a stock that was not only higher earlier today, it was also up yesterday as well on the heels of earnings. We will keep an eye on all that competition and bring you more as we know it. Now, coming up, we're going to look at another part of the market. Blue Owl co-CEO Marc Lipschultz joining us for an exclusive after this morning's earnings report and his own planned takeover, along with his colleague, of a stake in NHL's Tampa Bay Lightning. We're going to talk about that next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. We're going to turn now to the world of private credit. Blue Owl Capital reporting earnings this morning, matching estimates. We are joined now by Blue Owl's co-CEO, Marc Lipschultz, for an exclusive interview. He was also just recently announced as a future co-owner of the Tampa Bay Lightning NHL team. We are going to talk about that, too. Sports is a big asset class right now. But first, with earnings, private credit also a very big deal. 14 quarters in a row of growth you guys have had. You're sitting at records when it comes to fee-related earnings, and it was all borne forward by that private credit boom in a big way. What does this look like moving forward? Because when you talk to investors, there's a lot of question about how things change under a new interest rate scenario.
Well, thanks again for having me here today. And look, it's been a very, very good chapter for Blue Owl. We have had 14 consecutive quarters since we went public. We have grown our fee-related revenues at 35%. We've grown our fee-related earnings at 32% and our dividend at close to a 30% rate. And we're quite excited about the next chapter. You're absolutely right. Our origin, our roots lie in this direct lending business, which continues to grow and evolve. And its next phase ahead lies in places like asset-backed lending, There's new areas emerging around our real estate business, like hyperscale data centers. So actually, the future is very, very exciting from where we sit. Look, we offer something different from many. We don't offer all products to all people, but we offer what we believe are really the best of breed products, market leaders in a set of products that are about downside protection, durability, and predictability, and that's what Blue Owl itself is about.
You know, when it comes to products itself, you guys have expanded very meaningfully through acquisition. You have made a number of acquisitions this year in a very quick time frame, and I think when people look to the future, the question is, are you going to spend now time integrating those assets, or are you still looking to buy more?
Well, look, the integration starts day one and, frankly, long before we close. You think about businesses we've already acquired, we've got full integration and ready to roll together as a team. The thing about our acquisitions has been, and I think will continue to be, really marked by the following. You can build a product, organic development, and we do that where we have a unique, distinctive capability that just doesn't exist in the world. So triple net lease, our real estate strategy in Europe. We're already the market leader in the world in that business. We'll take it to Europe. But where there are other areas of opportunity that fit that DNA of downside protected, income-oriented products, then we want to look and say, do you buy or do you build? And I think we've landed in this spot that's a little bit of the hybrid between the two. We work with and join forces with an incredible team, like in the case of Atalaya, having the team join IPI. The team is joining. We're not buying their business, we're combining with the business. And then together, we're making that a better opportunity for the investors in the funds and for Blue Owl shareholders by accelerating the growth.
You know, it's interesting. You are a large private credit firm, real estate firm, private assets, but you're publicly traded. And when you look at others in the industry, Apollo, for example, there's this pitch that public and private are going to converge, that private credit is something that can be more easily traded. They're even building a trading desk to make that possible. Do you think that that's true, that all of a sudden you're going to look up one day and you can't tell the difference between public and private? Is it possible to make these markets be more liquid?
So a couple observations. Public and private, I might prefer the term, are increasingly adjacent, which is to say there are certainly areas that are bringing them closer, right? We have this whole family of continuously offered so-called products. We're designed for individual access, customized, but the same investment experience as institutions. And so I think there's definitely this increasing adjacency. But on the other hand, private markets are private for a reason. Our whole value proposition to the user of our capital is, look, you're going to pay us a premium and you're going to sign up for a much more restrictive loan document. And we're going to do deep diligence, but what we're going to give you is a long-term partnership. So I don't really think we want to disable the sort of durable long-term planning of private solutions. It's part of what makes them a private solution. The other observation I would share is this. Private solutions, if you want them in truly liquid form, it already exists. It already exists. We started this 10 years ago. We have a public BDC, ORCC, and if you want to be a participant in direct lending in fully liquid form, you can buy that. So I'm not sure I know what problem we're trying to solve by creating a bunch of trading in a non-traded underlying asset. But it's certainly true that they're getting more adjacent to each other.
I think it's a fascinating thing to talk about because you think about the largest trading desks on Wall Street, JP Morgan trying to make this happen, Goldman Sachs trying to make it happen. Do you think, especially if you're saying that these markets maybe are private you said they're private for a reason, does that mean that those banks just will not have the supply because firms like you and Ares won't offer it?
I mean, look, we are people that lend and hold the capital. And as you said, I think Ares and many others, follow similar strategies. I don't think it's not our mission to seek liquidity in the asset. Our mission is to make really great long-term loan decisions or long-term commitments to GPs in the case of our GP stakes business, or to Amazon if we're going to be their partner in developing a warehouse. And so I don't really think that we're seeking liquidity. Our job is to be their durable partner. We're in a premium for that. Our investors are in a premium for that. So I think we're quite happy with the structure of the market.
So another place you recently went into, I want to get your thoughts on this because we're sitting in the middle of big tech earnings, a lot of conversation about CapEx spending. You just bought a business to finance data centers. How big is the pipeline there?
That's a really great place to start. So the demand for data center capacity, physical, digital infrastructure, is measured in trillions, right? You just commenting, I know, on Google, and Google amongst the other large tech companies, they're all on this quest for the digital future. And that digital future is for sure a high growth one and requires a lot of compute power. Now, a data center is not a data center is not a data center. The reason that we acquired IPI, back to my earlier comment on best of breed capabilities, IPI has been doing hyperscale data center focused funds and investing for nearly 10 years now, long before the word hyperscale data center crossed the mind of most people. So it's a trendy topic. My guess is that every person that talks this quarter will use the word data centers. But here's the key. You have to be able to earn the trust of that long-term private partnership with these important hyperscale developers. And that's where IPI is truly distinctive. We have an 800-person operations group as an affiliate of IPI in order to be able to do the power management, the development, the conditioning. That's what the Microsofts and the Amazons and the Googles and the Metas are looking for, and that marries perfectly with our triple net lease business, where today we're a go-to partner of choice for holding the real assets, real estate assets of investment-grade counterparties.
Marc, we have to leave it there. We didn't even get to ask you about Tampa Bay. I will
Well,
ask
have me
you
back.
those questions offline. Blue Owl Capital co-CEO Marc Lipschultz. We're going to switch gears. We're going to go to the stock of the hour today. We're going to go take a trip out to the open seas because shares of Norwegian Cruise Line soaring today. After third quarter sales and profit beat Wall Street expectations, the cruise operator also raised its adjusted EPS forecast for the year, and investors are excited. They're hoping that they will capitalize off of strong travel demand. Perfect person to talk about this is Norwegian Cruise Line CEO Harry Sommer. So if you think about kind of the road ahead here, a lot of talk about the strong consumer. What does the pipeline look like going into the end of the year? What do you expect in terms of people traveling on cruises?
So thank you for having me on. We are really, really pleased with the American consumer right now. We're seeing incredibly strong demand, especially close in for our product, more so than even back in the good old days of 2018 and 19. The American consumer values experiences over goods. We think cruises in general provide a tremendous value and experience for our guests, and the results are showing in our numbers.
So if you think about any potential weaknesses, it's interesting because, yes, you've seen that strength in the U.S. consumer. What worries you, if anything, Harry, about the direction of travel?
Really nothing. The cruise industry is a relatively small part of the travel industry. So I think we have a way to go in terms of growth, and the future looks incredibly bright. We have incredible advanced visibility into our 2025 and even early visibility into 2026 sales. And things are looking to be exactly on track of where we need them to be to have meaningful price and EBITDA and EPS increases into 2025.
So if you think about 2025, given the strength that you've had already, are your plans for even further expansion? I mean, I'm wondering how far we can kind of take this appetite for people to get back out there.
The fortunate and unfortunate part of the cruise industry is it takes a long time to build a ship. We just cut steel, for example, on a ship that's being delivered at the end of 2026. So there's not much that we can do in the short term in order to increase capacity. We grow about 4, 5, or 6% a year, depending on the year in question. But it's also a blessing because it's hard. No one is going to flood the industry with unexpected supply. On an industry basis, we're not going to see more than this 4 or 5% growth on a year in, year out basis. So while it makes it a little bit more difficult to be opportunistic short term, it's absolutely healthy long term for the industry.
What do you think is the future for margin expansion here? What do costs look like moving forward, and how you think about that ability to kind of spend more to bring people on board, or whether there's some room to cut?
We've been super passionate since I took over as CEO about a year and a half ago to really take a much more holistic, balanced view towards costs. We call it a balance between ROI, which is the typical financial return on investment, and ROX, which means return on experience. That basically we want to invest in things that guests value. And that's really a sea change from how the previous CEO was looking at the company. And because of that, we've been able to emphasize investments in things that are important to guests, but we've been able to de-emphasize investments that are less important to guests. And that shows in our margin as well. Our margin expansion is going to be something like 500 basis points this year, which I think is our largest growth in margin from one year to next since we went public. We've had really strong focus on cost control. You know, absent an adjustment for dry dock days, our costs are essentially flat for 24 versus 23, despite some of the challenges in the world of inflation, especially in the earlier part of the year. And we look to continue with these sub-inflationary cost growths into 25 and 26 as well.
Harry, we thank you so much for joining us today. That is Harry Sommer, CEO of Norwegian Cruise Line. And be sure to tune into the close this afternoon for an alternative view on the travel industry. We have Booking CEO Glenn Fogel on a little later today. Interesting to see people get back on trains, planes, and automobiles, particularly into the holidays. We're going to go back to markets now. Take a look with Celine Zhao, Optiver's head of equity research. A lot to soak in today, and you are seeing some single stock names just surging. We've talked to some of them in this show. When you look out on the horizon, where are you finding buying opportunities? Is it those standouts that you see so much excitement around today, or are you taking into some of the high flyers that are actually dipping on a day like today?
Great, thanks for having me. Actually, Optiver is a market maker that provides liquidity for all major asset classes, where we mostly focus on option and derivative space. So I do think that there are a lot of color ahead of the big tech earnings week can be shared and could potentially actually answer your question there. You know, ahead of the big tech earnings week, we actually did not see any market panic or investor desiring to build position in the option market at all. And, you know, until today, where we saw a bit of a negative positive correlated negative move, I think there was really no, you know, desire to, you know, sell some of these high flyers ahead of, you know, the Meta and Microsoft results. Mm-hmm. So in terms of, you know, which name in particular, I do think we still have to wait and see a little bit until after Apple and Amazon. And, you know, currently the option market is still implying pretty in line to historical average of a market implied move. So I don't think we are fully there just yet.
Celine, we are up against the clock. We have just a little bit of time left in the show. We have to leave it there, and we thank you so very much for your analysis because, of course, yes, very hefty moves underneath the surface of this market. And, of course, yes, today is a down day, but we only have a couple days left until an election. It's the last day of October. Of course, it's been a down month. Maybe November will bring us something new. Big jobs report ahead tomorrow. Yields hanging out just a little high on that 10-year, but again, tomorrow is a new day. We'll see where it's headed. That does it for Bloomberg Markets. I'm Sonali Basak. Stick with us through Balance of Power. Stick with us through the close. This is Bloomberg.